Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Sibanye Stillwater stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Sibanye Stillwater mines platinum, palladium, and gold with operations in South Africa, Canada, Argentina, and the US. Half of the world's demand for gold is used in jewelry, a third in electronics. It's also used in coins, investing, etc. Half of platinum is used to make the catalytic converters, which is used in gas-powered cars. Jewelry is 1/4. The rest is chemicals, glass, electrical, petroleum, etc. Over 80% of palladium and rhodium are used in cars. The nice thing about investing in a company like this is if one commodity crashes in price, it can focus on other commodities. Smaller companies may not have this luxury if they only focus on one product. Just to give you a little background on the types of mining companies, there are two levels of mining companies. The first is a junior miner or exploration company. It raises money from investors or other mining companies to look for gold, platinum, etc. It is much riskier investing in a junior miner because they may never discover anything to mine, which happens more often than not. The flip side is when they are successful, these stocks blow up and can 10, 20, or 30x your money. If the stock is $1 or lower, then it's probably a junior miner. The second type of mining company is the major miner. These companies have lots of experience, are well capitalized, and are actively mining different commodities and selling them around the world. In order to value a major miner, it's not easy, but it is doable. You need to look at the mines it has and the amount of product it can pull from those mines and gauge the future prices of those commodities. When you invest in a commodity-linked company like a miner, the company is at the mercy of the spot price of the underlying commodity. You can do all the analysis in the world, but if you are invested in a copper mining company and the price of copper drops 70%, that company's stock will tank. A lot of people feel the demand for metals is expected to grow at a very fast rate in the next several years, mainly due to the large amount of battery electric vehicles that need to be built. Gold Fields Limited is one of the world's largest gold miners. Its subsidiary was GFI Mining. In 2012, it spun off that subsidiary and renamed it Sibanye. Each shareholder of Gold Fields received 1 share of Sibanye stock. The company is headquartered in South Africa and was founded in 2012. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Börse Stuttgart, Johannesburg, and London Stock Exchange. Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at $18 a share and they have 700 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had their most free cash flow in 2021 at 1.2 billion. It's up more than 4 times from 2018. It's up more than 11 times from 2019. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's over 2 billion in 2021, its highest ever. Revenue is a sales for the company and that grows every year. It's nearly 11 billion in 2021. This is the company's income statement. The top line is the revenue, the sales. Yahoo Finance has their financials in South African Rand, but I did convert their numbers to US dollars in my Excel spreadsheet. Their revenue in 2021 was over 170 billion Rand. Here's a breakdown of their revenue by product. 30 billion was from gold, 21 billion from platinum, 53 billion from palladium. The most was rhodium, 60 billion, and then smaller amounts in some other products. A big chunk of their revenue is in South Africa, but they do have a good amount in the US, 59 billion. Below revenue is the cost of revenue. These are all the expenses related to pulling the metals and also delivering them to the client. Revenue minus cost of revenue gives you your gross profit, and that was 60 billion, up a lot from 2018. Their gross margins are 35%. That's gross profit over revenue. which is worse than the average and median of their industry. But their net margins are 20%, a lot better than the median and average. Their operating expenses are $1.6 billion. Gross profit minus operating expenses gives you your operating income, and that was under $1 billion. Now it's close to $60 billion. They spent $1.8 billion of interest on their debt, which is less than prior years. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. These big negatives are asset impairments. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which was huge in 2021 and was also pretty big in 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they generated the most cash flow in 2021. It was $5 billion more than 2020 and more than triple 2019. Since they're a mining company, they spend a lot on CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow, and that peaked in 2021 at $19 billion. They pay a really nice dividend with this free cash flow, but in 2021 they bought back lots of stock, $8.5 billion. When a company buys back stock, it decreases the shares outstanding and it makes your shares more valuable. In 2021, they issued a similar amount of debt as they paid down. But before that, they were paying down a few $1 billion of debt each year. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And look how much those have improved over the years. It really took off in 2019. Their operating cash flow lagged their revenue by about 6 months. Starting in the beginning of 2020, their operating cash flow started to grow a lot. Since commodity prices are getting so high, it seems like the forecast is for the prices to decline. So their revenue is projected to decline over the next few years. Same thing with their operating cash flow. But even if they decline 5 to 10%, these numbers are still a lot higher than before 2020. This is their investing and financing sections from the statement of cash flows. And these numbers are in US dollars. They spent $861 million on property, plant, and equipment. They also spent another $122 million in other investments. This may be the investment in other mining companies. $30 million from the acquisition of equity investments. So in their investing section, they had a cash outflow of $1 billion. In the financing section, they added a similar amount of debt as they paid down, and they bought back $575 million of common stock. So in their financing section, they had a cash outflow of $565 million. Let's look at the capital structure. $5.1 billion of equity, $1.3 billion of debt. They're 80% equity, 20% debt. And they could pay off all the debt with the cash on their balance sheet and still have $600 million of cash left over. Their equity balance has grown a ton since 2015. Their debt has increased, but not nearly as much as their equity. And for the past year, they had more cash on their balance sheet than debt. I gave them a whack of 10%. That's the highest whack on Finbox. South Africa is a risky country to invest in. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $12 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $11.4 billion. We divide that by 702 million shares. And we get a calculated stock price of $16.29. They're trading at $17.62. They're trading at an 8% premium. It's a sell according to the model. The last time I did a video on this company, they were trading at $13.23, and my valuation was $17.24. So it's almost exactly where they're trading at right now. The price for a lot of commodities is getting really high, so I'm not sure how much more upside there is. Their revenue is projected to decrease 8.3%. That's how much I decreased their revenue in 2022. Then I decreased it 3% for the next 3 years. That's how I got their future revenue estimates. They convert 10% of their revenue into free cash flow, so I multiplied their future revenue estimates by 10%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $19. They're saying it's 7% undervalued. 4 analysts price this stock, and the average price target is 23. The low is 21, the high is 25. This is where the stock has been trading the last 5 years. The stock was really low in 2018 and 2019. It looks like it was below $2.50. It also got real low during the COVID crash, but it came up a ton since then, past $20. Then it came down a lot, and then it went right back up, but it has been regressing the past couple of weeks. I looked at the price chart for different metals, and it seems like palladium is the closest to this stock. Their stock price moves very similar to palladium. You can see all the dips are pretty much identical, and the stock almost hit its all-time high recently, just like palladium, and then it's come down in the past few weeks. So there's not much guesswork to valuing this company. Just look at the price of palladium, and that's where the stock goes. The S&P 500 is up 88% in the past 5 years, and this stock is up 113%. Plus, this stock pays a really nice dividend, so it's doing a lot better than S&P 500. They pay a great dividend, over 9%. They pay a semi-annual dividend. Look how low it was before 2021. They're bringing in so much more cash flow than before, so they're giving it back to their investors. Their dividend is 87% of their free cash flow, 50% of their net income. A few months ago, their yield was up to over 11%, and the projection is for their dividend yield to come down over the next few years. They have a beta of 1.3, so the stock is a little more volatile than the market. It's gone down 3% in the past 52 weeks, while the S&P is up 13%. The 52-week low is $11, the high is $21. And the stock is trading above its 50-day and 200-day moving average. In the past 10 trading days, nearly 8 million shares have been traded each day. Of the 702 million shares outstanding, 664 million are on float, 6.5% are held by institutions, and 1.5% of the shares are shorted. Their next dividend payment is April 7th, so you need to purchase the stock by 3/23 or before to get that April 7th dividend. Their employee count grew from 2016 to 2020. Then when COVID hit, they laid off a bunch of workers, but they brought all of them back. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $35,000 today. That's a 15% annual return. The general public owns 55% of the stock, institutions 40%, and private companies 5%. Their biggest shareholder is Gold One South Africa, 5.25%, then Allen Gray, BlackRock, 91 UK, and Fidelity. Let's look at their financial ratios. They have an amazing PE below 6, that's stock price over earnings per share. A really good price to sales of 1.1, that's stock price over sales per share. And a good price to book of 2.4, that's stock price over book value per share. Let's look at their non-current assets. These numbers are in US dollars. $4 billion of PP&E, $14 million of right-of-use assets. These are assets they lease from another company. $485 million of goodwill. Goodwill is the premium you pay when you acquire another company. $476 million of investments in other companies. $200 million of other investments. When they operate at a certain location, they may end up destroying parts of the land. So they posted $326 million, which will be used to clean up the environment. $41 million of receivables, and $57 million of deferred tax assets. Let's look at their non-current liabilities. $1.3 billion of debt, $11 million of lease liabilities, $518 million in rehab reserves. They owe $64 million on healthcare. This could be to its workers, or it could be to the people that were negatively affected when they operated in a certain area. They owe $177 million of stock-based compensation, $289 million of other payables, $389 million of deferred revenue. Deferred revenue is when a company prepays for a product or service before it's delivered, and $490 million of deferred tax liabilities. This will increase their taxes in the future. They have a really high return on invested capital of 66%. They can cover their interest payments more than 33 times. Their ROE is 42%. They can cover their current liabilities with their current assets more than 3 times. And a quick ratio of 1.9. Let's look at their current liabilities. $1.6 billion of inventory. Their inventory can be gold or palladium. $465 million of trade receivables. This is how much money is owed to them. $33 million in other receivables. $78 million of tax receivables. This is what's owed to them in taxes. $1.9 billion of cash, and $18 million of assets that are held for sale. Let's look at their current liabilities. $950 million of payables. This is how much money they owe others. $300 million of other payables. And everything else is pretty small. They generated $1.2 billion of free cash flow in 2021. They have $2.8 billion of working capital, and they paid out over $1.1 billion of dividend payments. So they have $2.9 billion of funding. So it looks like they have enough money to get through the next 12 months without needing any more debt. The best way to look at ratios to compare them to companies in the same industry. There are 44 companies in the same industry as Sibanye, and they're ranked 7th in market cap at 12.4 billion. The average is 6 billion. Almost all their numbers are better than average. They pay a really high dividend. Their price multiples are really good. Investors are less likely to invest in a company in South Africa than a company in the US, or even a company in Canada or the UK. That's why they have such good price multiples. They have a really high 3-year annual growth rate of 41%, and their ROE is 42%. That's net income over equity. So to summarize, I have them trading at an 8% premium. Even if the stock doesn't go up, you still get a really great return because they pay a huge dividend. Their stock price and their dividend payment is really dependent on the price of gold, palladium, and all the commodities they mine. So if those keep going up, then you can make a lot of money with this stock. I rank their free cash flow 7 out of 10, their revenue 10 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.